Hello traders, welcome back to another episode of Smart Keys FX. Supply, demand and order blocks are powerful smart money concept strategies that works perfectly well if identified at the most optimal trading zones. Most traders mark random supply and demand areas without understanding the foundation and key indicators of institutional blueprints. Regardless of the strategies you trade, if you can't identify high-quality institutional levels, you are vulnerable to market manipulation and consider yourself as liquidity, which fuels the market to their intended direction. In this episode, I will show you how to identify high-quality supply and demand areas and most importantly, how to combine them with Forex pairs confluence to align your trade with institutional direction and increase your win rate. Please subscribe and give this video a thumbs up. We appreciate your support. Let's understand supply and demand zones and the psychology behind their foundation. Supply and demand are zones in the market where significant selling and buying have taken place in the market, hence causing aggressive price movements. These aggressive moves can only be caused by institutions stepping into the market. Let's see how these zones are formed. Here, the market is in an uptrend, and we only focus on buying opportunities. You can see that the market has reversed upon hitting this level, maybe due to profit-taking or buyers stepping into the market. This level is therefore seen as the best price to sell at. This area therefore becomes a potential resistance in future. Again, the price hits this level and reverses upwards, showing buyers coming back to the market. Buyers will see this level as the best price to buy at. This level now forms a potential support in future. Now that we have established support and resistance, retail traders will tend to sell the market at this resistance level and place their stop losses above the resistance level. At the same time, breakout traders will put their buy stops above the resistance level with their stop losses below the resistance. This creates tons of liquidity above the resistance. Meanwhile, at the support level, retail traders will buy the market placing their stop losses below the support. Breakout sellers will also put their sell stops below the support, with their stop losses above the support. This also creates turns of liquidity below the support. This is a trap created by the large players in the market. Institutions with their large orders which they cannot offload at once, will then scale in their orders into the market as they sweep both the buy side and sell side liquidity. Since the best discounted price within this consolidation is below the support, they will wick the price down, sweep the buyer's stop losses and drive the market up, clearing any liquidity on its way up. This therefore forms our demand zone. We now wait for the market to come back to this demand zone and take a buy position after confirmation. The same principle applies to supply zone. After this distribution, the market sweeps this level and aggressive moves to the downside. This creates this supply zone. We then wait for the market to retrace back to this level and take a sell position after confirmation. Now, what are the variations of supply and demand zones? To start with supply, the first type is the rally-based drop. This is where the market rallies up, distributes and drops after gathering enough momentum. The second type is the drop-based drop. In this variation, price drops, consolidates to gather momentum and drops again. In demand zone, the first type is the drop-based rally. Here, the market drops, accumulates to gather more liquidity and rallies up. The second type of demand zone is the rally-based rally demand zone. Here, the market rallies up, consolidates to gather more momentum and rallies up again. In each type, the zone is only validated by a sweep of liquidity which shows institutions' footprints. So, let's analyze supply and demand zones in the real charts. We must ensure that we only pick zones that are in line with the higher timeframe direction. So, here we have an uptrending market, characterized by higher highs and higher lows. Our main task is to identify an area of consolidation before an aggressive push to the upside. Personally, I must ensure that the following checklist are met before validating a demand zone. This help in preventing guesswork. 1. Has liquidity been swept before the move? We can see this bearish candle that wicked below these relatively equal lows. 2. Has the price left the area of consolidation with high momentum? We can see these huge consecutive bullish candles. This inside bar candlestick pattern also strengthens our bias, as it shows a brief pause in the market before leaving this area. In addition, it took only 5 candles to break this structure, while it took almost 9 candles to retrace back to this level. This shows weak selling and more bullish pressure. 3. Has the price left an imbalance or fair value gap? We can see that there is an imbalance between these two candles. This candle wick did not overlap this candle wick. Now that all our criteria are met, we zoom into the lower time frame for trade confirmation. Here in the lower time frame of GBP/USD, we wait for the market to come back to our higher time frame demand zone. We can see this order block formed at this lower time frame demand zone. This is formed to induce early buyers into entering the market. With this bullish engulfing candle, they will put their stop losses here. The market then stops them out and continues to the downside. Point to note here is that we only focus on extreme order block formed at the higher time frame demand zone. Now that the market has grabbed liquidity for early buyers, let's analyze the price at our higher time frame demand zone. We can see that price tried to break this level but immediately got rejected. This forms this indecisional candlestick. This bullish engulfing candle after this bearish candle shows loss of selling momentum. So, we look for this impulsive candle that breaks out of this minor consolidation. We can see a fair value gap formed here which further strengthens this last candle as our order block. Before we place our buy position, we need an extra confirmation for us to take this trade. This is where Forex pairs confluence comes in handy. We can look at Euro-USD and see if the same weakness in USD can also be seen there, since this pairs are correlated. With this pairs side by side, we can see that Euro-USD is overly bullish and has already shown buying pressure. We can now place our buy position here and target a 1-to-2 risk to reward ratio. Let's look at an example of supply zone. We have a clear downtrending market in GBP/USD. We only focus on selling. Here, we can see a sweep of liquidity before this impulsive move to the downside. The market is aggressive, and a fair value gap has been created here. All our criteria are met, so we zoom into the lower time frame for trade confirmation. Here, we can see this bearish engulfing candle, immediately after this inverted hammer. This forms our lower time frame order block. As the price retests this level, it gets rejected by this inverted hammer which is then followed by these two bearish candles. For extra confirmation, we also look at Euro-USD to see if the same strength of USD can be seen. You can also see a rejection in Euro-USD followed by a bearish engulfing candle. These two pairs are now aligned showing strength in USD. We can then initiate a sell position here, with a 1-to-2 risk to reward ratio. So traders, supply and demand zones are fractal and works in every time frame. Have a checklist and backtest before trading in the live market. Thanks for watching, we always appreciate your support. See you in the next video.